Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the share screen and the disclaimer and be aware that Market Chameleon, myself, and Dimitri are not registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a registered representative. This show is for informational purposes only concerning Market Chameleon tools and products. With that, D, are you ready to go?
Yep. Good morning, everyone. Let me share my screen here. And if you are joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, and the analytics. If you have a question, type it into that live chat on YouTube. Will's keeping an eye on it, and he'll let me know and read it back to me. And to give you a couple minutes to type those questions in, we're going to take a look at our pre-market report, see if we could get insights, what's going on in pre-market hours, and then we will move on to our questions. So up here, we have our pre-market report, and you will see a calendar view up top. This also shows summary statistics, what happened in pre-market hours on that date. The idea there is to be able to compare today's date, what's going on with the most recent history, and you could spot if something is unusual. Maybe there's a trend that you could eyeball. You can go back to historical date and see what happened in a pre-market hours on that date. Let's go over today. This is May 31st over here. Here we see we have 561 stocks trading higher in the pre-market, 250 stocks trading lower. We have 297 million shares trading on up volume, 104 million shares trading on down volume. We have $5.4 billion worth of stock trading higher, $1 billion worth of stock trading lower. So that indicates that there is a bullish bias so far in the pre-market trading activity. Let's take a look at it from a couple more perspectives, then we will move on to our questions. And I'm going to scroll down towards halfway down the page. And now we get this more granular view of what's happening in the pre-market hours. We see stock symbols, price changes, volume. We also have our most active list, our biggest percentage gainers, biggest percentage decliners. I see we have 100 stocks that made it onto our biggest percentage gainers list, 62 on our biggest decliners. So this also points to a slightly more bullish bias in pre-market trading. Now, to make it onto this list, we set thresholds because stocks in the pre-market could trade on very low volume, very low liquidity. If it meets those thresholds, this stock could make it onto this list, and that will include small cap stocks. It could be an ETF. It could be a leveraged ETF, an inverse ETF. So to narrow down this list further, we could use our filters above here. If you have a watch list and you track a certain group of stocks, you could use this in my watch list filter to filter down this list to that group of stocks you saved. We're going to use this filter here in ETF in our example. I'm going to click on it. You get a drop-down menu to select from the different ETFs. Let's choose SPY up here. And when we do that, the list below gets filtered by stocks that are holdings in the SPY ETF. And what we did here was narrow down the group of stocks we're analyzing to the S&P 500 stocks, because SPY is the S&P 500 ETF. Here we have 11 stocks made it onto our biggest percentage gainers list, 3 on our biggest decliners. So that also points to a slightly more bullish bias in pre-market trading. So we looked at it from 3 different perspectives. They all indicate a little bit of a positive lean in pre-market trading activity. And well, I did give it a couple minutes, so if we have questions, I'll take those questions now.
Nothing's popped up, D.
Okay. So let me navigate to SPY here. And let's come back to our under options, the single leg dashboard. And what we started covering this because it's a relatively new tool. And what this tool does is isolate single leg option trades. So when options trade, you could enter in, buy or sell a call or put, but you could also enter in a trade that is a call spread, a put spread, a butterfly. And if you're designating it that way, that you want those legs to get filled simultaneously, it will get tagged as a multi-leg trade because that's how the order comes in. That's how the exchanges tag it. And this takes just single leg trades that they were reported as, either call or put without a stock contingent, without another option contingent. And we analyze these trades separately. So you could see here in SPY, there were 5.9 million contracts, a little bit over 5.9 million contracts that were single leg trades. And here, out of the total volume of 7 million. So you could see here that or actually, we could go here to the activity first. We just hit on this activity over here. We could see that 85% of the options were single leg trades, 15% yesterday in SPY were multi-leg trades, and the less than 1% were contingent trades. Right, so let's go back to the single leg dashboard here. So this is the breakdown of calls versus puts. So almost even, 48% calls, 52% puts. If we just looked at our interpretation of where the end users, coming in, the market, the takers, the initiators, the interpretation, which way were they coming in, it was equally around 51% of them were from buy side, 49% from the sell side. This is how the options were executed. 71% were auto execution. I mean, they were executed electronically on the exchange, where the matching engine matched up the order, and that could involve where the trade gets filled immediately, on the bid, on the offer, or it could be or something in between, or it could be an option that is on the limit order book, right? So you put a limit order to buy or sell. If it doesn't get executed immediately, what it will do is get posted on the order book, on the limit order book on that exchange. And it could sit there if it's away from the NBBO. It'll sit there. If it's on the NBBO, somebody could come in and sell it or buy it, and that will be an auto execution. It just automatically got executed. Then we got 20%, which hit the price improvement auction. So what this is that these are orders that came into the exchange. They were within the MBBO, probably, marketable, and they get stopped by the exchange. And before they get posted or executed, they get, we call like flashed to the market makers and specialists for a price improvement, meaning that, let's say you wanted to buy something at $1.10. Well, there are competitors out there that may need to sell it, and because there's competition, they might improve and say, I'll sell it for $1.09 because I want to sell it and I want to be the one to sell it for $1.08. So what happens here is that 20% of the order flow hit the price improvement auction and got executed. And that just shows you that there's competition. There are competition there between market makers and specialists, or these hidden orders in between the MBBO that are willing to improve the price. So it shows you the liquidity and the opportunity to get a better fill, right? Better quality execution. So that's 20% of the order flow, 20% of the volume hit the price improvement auction. 9% of them were intermarket sweep orders. Well, what's an intermarket sweep order? That's a special order type that you would have to select. It's not just the regular limit order, and not even a regular market order. You'd have to select specifically to enter an intermarket sweep order, and that is considered an aggressive order because if you want to access liquidity, or if you want to say, I need to get 100, 200, 300 options, right? Like of this option. And I see that there are multiple exchanges with offers. But some of the offers, are a little bit better, some are a little bit worse. But I don't want to go to each exchange based on the best offer, because when I do that, it takes time. If I have to go to the SIBO, I bought 10 there. Then I have to go to the Amex. I bought 10 there. Then I have to go. If I do that, the stock could move and the offers could move. So what an intermarket sweep order does is say, go simultaneously and take the offer or hit the bid on all these exchanges that I designate. So you might get an inferior price first because you're going simultaneously to all these exchanges, right? You're basically saying that I'm going to opt out of the price protection rule, right? That I'm gonna get the best MBBO price. I'm opting out of that. I'm going to bypass that rule because I want to access the liquidity, and I want to make sure that, I get the quantity of contracts that I'm seeking before the market moves away from me. So that would be an intermarket sweep order. 9% of the volume was tagged as intermarket sweeps. A floor trade looks like there's less than 1%, so there weren't that many. But what is a floor trade? That's a trade that is not executed electronically. Most of you guys are probably doing trades that are electronic. You enter it in through your execution platform, right? You click on it, you send it, and it goes to the routes to the exchanges. Now, floor trader is different. You're using a person, it's human touch. You're probably using a phone, and you're asking a broker, look, I have this order that I want to execute. It might be a complicated order, it could be just a large size order. Right? Let's say you have this butterfly and you want to negotiate and say, I'm looking for the other side. Would somebody be willing to trade this? Maybe I want to do it mid-market. Maybe I want to do it at certain prices. Maybe I want to do contingent, with the stock here, or maybe involve the stock. But you're trying to negotiate and find the other side. And a broker could take that order and start to shop it around, right? Shopping it around. Is that what we call it? Well, shopping around on the floor. You're going to go to a specialist. You might go.
Yeah, no, they definitely shop it around. And not only on the floor, they'll call customers upstairs.
Exactly.
And shop the order around.
Right. So the idea there is to find more interested parties, let them know about it, let them, because a broker has other customers that are trading with sizable accounts, and they could contact those customers. They could contact the specialists on different exchanges, right? They could go and call their specialists on the Amex and their market makers. They could call the Chicago specialists and market makers and say, hey, I'm shopping this around. Would you be interested in it? So they're creating competition for the other side, right? Because they want to try to get them a better fill, a better execution. It's either price or the quantity, right? Sometimes the issue is not the price, it's the quantity of that the other side is interested in. Said, I want to do this trade, but only if I get like 10,000 contracts, and how can a broker help with that? Well, maybe there isn't a single counterparty that's willing to do 10,000. Maybe they're only willing to do 1,000. But if the broker calls up 10 different customers saying, okay, we're willing to do 1,000 at this price, then that customer got all 10,000 at that one price. So that's what we're looking for. The floor trades are more negotiated human touch trades, and they tend to be bigger in size, and that's because they're looking either to improve the price, try to negotiate and create competition for a better price, or they need a bigger quantity that's just displayed on the screen. Right, so those are the floor trades. Then we could go over here and look at the actual trade execute, where the price was executed versus the state of the market at that point in time. So when you think about the exchanges, there's actually two different pipelines. There's one where they show you bids and offers. And bids and offers are what we call the state, what I refer to as it's the state of the current market, where somebody is willing to buy something at this price, and it's a firm bid, meaning that if you hit that bid, if you want to sell it on that bid, the person's obligated to buy it. So as long as it's being displayed on the exchange, if you're providing that liquidity, if you don't cancel it and somebody sells it to you, you're obligated to buy it.
Hey, D?
Yeah.
Tiffany's asking, can you help define small in the trader size?
Yeah. Okay. Yeah. So I'll get to that one too. So there are two different pipelines. One is it reports executions. One it reports the bids and offers, the liquidity, whatever the liquidity providers are displaying, and then the executions. All right, so we have liquidity providers, liquidity takers. So where did the execution occur relative to the bids and offers? So we see here 36% of the trades got executed where the bid was, 41% on the ask. 2% were below the midpoint, but closer to the bid. 2% were above the midpoint, closer to the ask. 1% were below the bid. 1% was above the ask. And this will happen when you have intermarket sweeps. Remember, we just discussed the intermarket sweeps can get an inferior price because they're going after the liquidity and they'll bypass the price protection rule. Right? 18% were right at midpoint. So this gives us an idea how these trades are executed versus the market. 18% is pretty good right at midpoint. So there's a good amount of liquidity, and we're talking about SPY here. So there's a good amount of liquidity in there. I'm going to scroll down here, and then, we have these breakdowns. And here, I should just probably put the breakdown here, but when we look at the orders, and the trades, right? So when we look at the trade executions, we know a couple things about it. One of the things we know about the trade execution is the volume, the size of the trade. We know the price, but we also know the volume. Was it one contract? Was it two contracts? Was it 100 contracts that were involved in the execution? And sometimes it could be in a series. Sometimes you'll see a very quick, you'll see 10 lot, 10 lot, 10 lot, 10, 10, 10, 10, because it's sweeping the book. So we would aggregate those, right? So then we take these trades, right? We aggregate this big series. We isolate the ones that are not part of it. And now we have these trade quantities, right? Sometimes it's a 1 lot, sometimes it's a 5 lot, sometimes it's 1,000 or 100. And what we're trying to do is say, okay, given all that, there's lots of trades going on. What is the distribution of those, right? What are the distributions of smaller trades versus larger trades versus medium-sized trades? And how do we categorize them, right? So different people could have different opinions on that as well. What constitutes a small trades, what constitutes a big trades. It's kind of like saying, what is a large market cap stock? What is a small market cap stock? What is it? There's no exact number, you can't say small cap stock is exactly, a $10,500,431. We can't say that. So we have to put it somewhere in the bucket where, where it's reasonable to say, okay, small cap stock is this, a large cap stock is this, a mega cap stock is that. So when we look at and when we look at those trades, we say, okay, well, what is a typical small trade, in SPY? Obviously like a 1 lot that is $100, $100 would consider that's a small trade. If there was nothing else around it, that would be consistent with a small trade, small trader type, right? Something with 1,000 contracts that's $1 million in notional. That's not a typical retail trader. That would be considered a larger trader. So when we created this, we said, okay, well, what kind of buckets can we create? We could create just very small and very large, but there's something in between there as well, right? There's something where there's very small trades that are occurring. There are very large trades, but there's also something in between. It's like you have small cap stocks, you have mega cap stocks, but you got like mid-size, you have large cap, right? So we came up with 4 different buckets. So the very small trades, we said, okay, there are a lot of trades out there we would consider small as like a 10 uh 10 contracts or less. So 1, 2, 3, and in notional less than $10,000 in notional value. So we consider that in our small trade bucket. We came up with it because we did an analysis on all the trades. Also, if you open up a brokerage account, and many of you might know this, they ask you, what's your experience, how many years, what's your knowledge, and so forth. So when you trade options, you're going to have restrictions based on that. And you would have to, trade for some time before they lift those restrictions and block you. Like, for example, you won't be able to sell naked options if you have no experience at all. And even if you have $1 million in your account, and if you have no option experience, a brokerage firm may say, okay, you're restricted to buying options only in a 10 lot and not above this. So there are restrictions anyway, like it would be based on, your experience, how much you have in your account and so forth. So given all this, say, okay, this is between 1 and 10 contracts, less than 10,000. If that's the only trade we see, we put that in a small bucket. Now, there are retail traders out there. Many of you are. Most of our, if customers I know who are retail traders will probably fall into this bucket here, where the trade could be, a little bit higher already. It's maybe between more than 10 contracts, like 11 contracts, 12, going up to 50, we would say, and less than $50,000 in notional. So the retail traders in options, okay, particularly in options, they'll tend to have a more sizable account, right? So you do have those small accounts, but they won't last that long. But the retail trader who's active in the options will have a more sizable account, and they'll be somewhere in this bucket. They'll do some they'll fall between small trades and retail size trades, somewhere in this bucket here. And of course, and we did that, we're looking at the analysis of the trades, and that's where we think they fall into. Now, when you get above that, trade where you're, above 50 and above.
AD?
Yeah.
We got a question from Juan about single leg. Where are the code for single contracts? I'm not exactly sure what he's asking. Would you know what he's asking for? What is the code for single contracts?
I mean, I'm not sure what you mean by code, but the option trades themselves, right, get reported to OPRA, okay, Options Reporting Authority. So Option Pricing Reporting Authority. OPRA gives you have trade, you have trades that are reported executions, and then you have the bids and offers, right? They come in, you have a few different pipelines that you're receiving data from. When something gets executed, right, OPRA has different fields with the description of the execution. Okay, that comes from the OPRA feed that's reported from the executing member exchange to OPRA. OPRA has a standardized feed. You could go read it. It's thousands of pages long, probably, but you could go and find that OPRA feed. But what it will look like is, let me see if I could give you, here, I'll go to the, let me just go to a stock that's doesn't, let me try to go to the time and sales here. So what it will do is give you a different fields describing the execution. So here's a time in sales, for example, for SPY. So what are time in sales? These are executed trades. They'll give you the timestamp. When was the trade executed? They'll tell you the description of the option, so your put, expiration, strike. They'll tell you what the quantity of the trade was. This was 5. They'll tell you the price of the trade. The notional is something we calculate. Here's the bid and offer. The bid and offer, like I said, comes in a different pipeline, right? Because you have bids, offers, you have executions, but we could take the timestamps and match it up. So we look at what the bid and offer is at the time of this execution. This we calculate because we compare the price versus the market. These are calculated, IV and so forth, delta, open interest you'll get. They'll tell you what exchange it was executed on, right? So Oprah will tell you this was on a Phillips, this was on a, they'll tell you the condition over here. So here's the auto execution. So that's where we get the auto execution. Now, if this was a multi-leg trade, if somebody entered in a call spread or puts, they would have to specifically enter that in though, right? So if you go, into your account and you say, buy and sell this simultaneously at this price, it's going to be, that means that's the condition. They both have to get executed. Then right here, you see this condition here? They will tell you it was a multi-leg right here. So it's under the trade condition. Again, that gets reported by the Oprah feed. All right, then you get other descriptions here. It hit the complex order book. This got executed electronically on the complex order book. So, actually, we went past 9:30, so I'm going to stop there.
Yeah, we did actually have a couple questions today. I didn't want to stop you because you were on a roll.
Okay.
I did get the ones relevant to what we were talking about, but Dimitro asked, every day dozens of articles will appear on MC. Who writes the articles? Is the assessment of the articles? Anyways, I'm sending that to you. Maybe we can discuss that on Monday. Sure. Mike had a question about the NVIDIA split. Is it worth buying pre-split or after split? But I'll take all these questions down. And another one about option volume, another one's about the earnings calendar, and I'll send them to you and we can go over them on Monday.
Okay, awesome. All right, well, thanks everyone for joining. Thank you for the questions. Really appreciate it. And hope to see you guys on Monday. Have a great weekend.
Have a great trading day, everyone, and a great weekend, and we'll see you Monday. Thanks, Dee.
Bye.